My name's Adam and welcome to the channel. Thanks for joining us today. If you haven't already, please subscribe to the channel. Starting next week, we're gonna start our mini-series courses. So throughout the month of October and every month moving forward, we're gonna release short mini-series on one topic. In today's video, we're gonna help you determine when to use a RRSP or a TFSA for your investments. It's the number one question we get from our clients is, I have a bucket of money. I don't know if I should use a RRSP or a TFSA for this investment money. So we're gonna help you determine that. And by the end of this video, you'll know exactly what to do with your money, where to invest it to minimize your tax and create a long-term financial plan with that money. Stay with us right to the end and we'll show you some tips and tricks on when to use both accounts, RRSP and TFSA, for your investments. The TFSA is a registered tax-sheltered account. The money you put into a TFSA is after-tax money. The growth and everything you take out down the road is all tax-free. It is a registered account with CRA, and it was released in 2009 by the federal government. We have much more on TFSA, tax-free savings accounts, in our TFSA video. We'll put a link below and also a card above. You can click on that now if you want to watch our TFSA. An RRSP is also a registered investment account with the CRA. An RRSP provides you a tax deduction on contributions. But on the flip side, and different from a TFSA, is that when you redeem money from your RRSP, that money is going to be taxable for you. So whether you take it out in retirement, or if you have an emergency or need the money before retirement and take it out, it will be taxable income to you. So tax break going into an RRSP, but taxable coming out. An RRSP is primarily used for retirement savings, and we recommend it only to be used for retirement savings. You have a limit of 18% of your annual income, up to a maximum every year. So in 2020, the maximum you could put in is $27,230. That does not include any carryovers you have from previous years. So you may have carryovers and you might have over $100,000 in contribution room. You could put over $100,000 in then, but your annual contribution limit is 18% of earned income. So now into when to use a TFSA or an RRSP. We try and keep it as simple as possible, and that is the income level. So if your income is below $50,000, a TFSA on the most part will make the most sense. If your income is above $50,000, look to use an RRSP. The reason for that is because you're in a higher tax bracket and you could use the tax deduction to lower your tax bill going forward. So a TFSA below $50,000, a RRSP above $50,000. Other things that come into play other than your income would be the objectives and goals behind the investment. If you have $10,000 or $50,000 or $100,000 that you're saving for a down payment on a home, buy a new vehicle, help the kids out with college or their home purchase, obviously that money, even if your income's above $50,000, you would not be putting that money to an RRSP because you need it shorter term and you need flexibility. So look at the purpose of the investment itself or the money itself, what you need to use it for. If it is for retirement, then use that income threshold of $50,000 as a starting point. If it's for something else where you need the money shorter term, then use a tax-free savings account. Do not lock money into an RRSP that you will need on a short-term basis or anytime before retirement. An RRSP makes the most sense as your income grows. So if you're at $55,000 in income, but you know that next year it's going to be $65,000 and keep growing from there, then you may want to sit down with your accountant or financial planner and create a strategy behind your RRSP, because you can build up your limit from year to year and maybe maximize it more down the road. So if you know you have a growing income, even though you're above $50,000 right now, maybe look to hold off, use the tax-free savings, and you can always transfer your tax-free savings into your RRSP in 2 or 3 years from now when your income's higher, giving you a larger tax deduction and tax refund. So as promised, I want to go through when it makes sense to use both an RRSP and a TFSA. The most obvious answer is when you have money that's going to be used both for retirement and short term. So obviously you're going to put some into RRSP, some into tax-free. But what I want to cover is the less obvious times when you want to look to use both RRSP and tax-free savings account. So when we use this strategy, and it's used quite often because of the average income in Canada, is when your income is just over $50,000. So let's say you have a $60,000 income and you want to make a $15,000 investment this year. What we're going to do is put in to your RRSP until you hit the tax bracket, when your tax bracket drops. So check your provincial and federal tax rates. It's right around $50,000 for most provinces and territories. So you want to, let's say it's $50,000 exactly, and your income's $60,000. You'd put in $10,000 to your RRSP, and then the other $5,000 you would put into your TFSA, because your tax rate drops from, let's say, 28% to 22%. So if you put that extra $5,000 into an RRSP, your tax refund isn't worth it. It's more beneficial to put that money into a tax-free savings account, let it grow up over time, and be able to pull it out tax-free either before or in retirement. So it's kind of maximizing your tax rates and your tax refund along the way. The last thing I want to touch on is using your tax-free savings in the short term to transfer to your RRSP in the long term. So we meet with a lot of clients early in the year, January, February, March, to do tax planning. And we don't know what their income. It could be commission salespeople or someone that gets a bonus, but it's fluctuates based on how the company does that they work for. So their income is very unknown. So what we'll use for strategy is we'll actually put their monthly contributions into a tax-free savings account. At the end of the year, late November, early December, we'll sit down and look at their actual income for the year, look at what bonuses and commissions they earned. If it's high, or if it's where we expected it to be, then what we'll do is we'll actually transfer their TFSA into their RRSP. So what that's done is it's created the flexibility along the way. And when they need the tax break at the end of the year, once we figured out the taxes that they're going to be due, then we can move tax-free into RRSP, lowering their tax bill and using that RRSP that we always intended to use. We just weren't sure how much to use. So with this strategy, we're not burning your RRSP room. Once you use RRSP room, it's gone forever. Whereas tax-free savings, you get back the following calendar year. So again, if we've used their tax-free throughout the year, but we pull it out before December 31st year end, on January 1st the next year, so it could be the next day, they get that TFSA contribution room back. So it's not wasted. So it's a strategy to use if you are uncertain of your income or get paid maybe bonuses or commission in your job. So something to think about. Use your tax-free strategy throughout the year, make an year-end RRSP contribution, but do it before December 31st so that you get your TFSA room back. Thanks for watching our video today. I hope you enjoyed it. I hope you learned a bit about RRSP, TFSA, and when to use each account. Make sure to subscribe to the channel if you haven't already. And please, if you liked the video, hit the little like button. It really helps the video get pushed out to other people so that more people can learn this content. A reminder, next week we're going to start our mini series, so make sure you subscribe and hit the notification bell so you get notification on when we launch that. Again, thanks for joining and have a good day.